So good afternoon and welcome to the July 2022 Executive Committee meeting of the New York City Board of Education Retirement System. Today is Thursday, July 21st, 2022, and the time is 1:04 p.m. As a reminder, the Executive Committee is being recorded for those who cannot attend and will be posted to the BERS YouTube channel at the conclusion of this meeting. Start by calling the roll. Russell Buckley.
On behalf of Chancellor David C. Banks and Interim CFO Benjamin Schambach, I am present.
Perfect. Donald Nesbitt.
Present.
Thank you. Nicholas Sudo.
Present.
Okay. We have Gregory Faulkner.
Present.
Thank you. We have a quorum. I would also like to note for the record that Allison Hirsch, designee for the New York City Comptroller Brad Lander, is also in attendance. Before we begin, I would like to note a few changes to the agenda for today's meeting. First, the discussion on legal services will be moved into executive session since it pertains to a potential individual fund investment. The vote on this item will still take place in public session. Second, we are asking to pull the final item on the agenda, an update on lawsuit research for potential investment managers, in response to trustee questions and comments at our May and June 2022 Executive Committee meeting. We are still preparing our full presentation, but want to let you know we are working on it, and we'll have a full response at the next Executive Committee meeting. Any questions or concerns with these two modifications?
Antonio.
Yes.
I do have a question on
Absolutely.
attendance from the controller's office at this meeting. Don't we need a vote from the full board to add a member to the executive committee?
So today, any member of the board is welcome to attend the executive committee meetings. Ms. Hirsch is in as an observer as a board member. But as far as quorum is concerned and votes are concerned, the current executive committee from the resolution for the full board will be only board members will be voting today. But any board member can attend as far as for
Okay.
observation purposes.
Okay, that's fine. Thank you.
All right. Any other questions or concerns? All right. Hearing none, I'd like to start the meeting with our first item on the modified agenda, approval of the minutes for the June 16th, 2022 Executive Committee meeting, a summary of which was in your packets. Can I get a motion to approve the minutes?
Motion.
Sorry, I'm late.
No problem. Just want to, for the record, Tom Shepard has joined the meeting as well. Who did I hear the motion from?
Donald Nesbitt.
Thank you, Donald. Second. Greg, are you speaking? Can't hear you. I don't know if
Well, I'll second.
Thank you.
I'm just having some technical issues. I'm sorry.
No worries. Thank you. Any discussion? All those in favor, please say aye.
Aye.
Nick.
All right. Any opposed? Any abstentions? The motion carries. The next item for our modified agenda is an authorization to renew a one-year subscription agreement with PitchBook to provide private market research services. Can I get a motion to consider?
So moved.
Thank you, Tom. Second?
Second, Donald Nesbitt.
Thank you, Donald. All right. So as a reminder, at the last board meeting, the executive committee's powers were extended to approve contracts under a certain amount. This PitchBook agreement would fall under those thresholds. PitchBook is a private market company manager and fund research platform that provides data, analytics, news coverage for private market asset classes. BERS Investment Strategy currently uses PitchBook for monitoring current fund investments, first cut research and due diligence that may be unavailable in private market manager data rooms, and overviews of new developments in private asset classes and strategies like climate and clean technology, as well as other potential areas of interest for the Board of Trustees. This is a renewal of subscription. The cost is not to exceed $25,000, which is a $4,000 increase from the renewal 1 year ago. And we believe a one-year renewal provides flexibility while we evaluate whether a long-term contract is feasible and or advisable. A memo on our rationale and length of agreement and next steps was included in your packet, and I'm happy to answer any questions. Okay. Right. Hearing none, may I have a motion to approve a one-year renewal for subscription to PitchBook at a cost not to exceed $25,000?
Motion made. Donald Nesbitt.
Thank you, Donald. You have a second.
Second, Nick Soto.
Thank you, Nick. Any further discussion? All those in favor, please say aye.
Aye.
Aye, Donald.
Aye, Tom.
Aye, Nick.
Thank you. All right. Any opposed? Any abstentions? Motion carries. So the next item on the modified agenda for public session is just an update on the NYCBERS investment program. This will be a standing item as we discuss this moving forward. The only update I have for today is that we have started our dialogue with the Bureau of Asset Management in earnest on what a collaborative arrangement for BERS investment program could look like. We're beginning by working in collaboration on a private equity investment for the board's consideration in the fourth quarter of this year. We have a standing meeting to discuss and monitor progress, and we'll be taking input on how you all would like to see the relationship function over the coming weeks and months ahead. Like I said, we have those standing meetings and discussions, and we look forward to working with the Comptroller's Office on due diligence, compliance, and legal on this particular private equity investment. I'm happy to answer any questions, opening up to staff or to Allison, who's representing the Comptroller's Office, for any comments. Like I said, this will be a standing item on the agenda, and we'll make sure to keep you all updated as things progress.
Hi everyone. It is really great to be here, and I'm looking forward to being a member of this board moving forward. It's very exciting. I think Antonio laid it out really well. One of the issues that has arisen between BERS and the Bureau of Asset Management over the past many years has been a desire by the trustees and leadership of BERS to have the opportunity to have a slightly more unique portfolio potentially than some of the larger funds in the system. And I know that in the past that has been sort of met with a hard no, and and I think what we're hoping is at the beginning of this collaboration around Base 10 is sign in the right direction, that under this administration there is a lot more openness and desire to work with each of the 5 systems and the boards of trustees of each of the 5 systems to identify the right portfolio makeup, and for those independent systems, and thinking about them as independent systems and not simply one large pot. So that is the hope, and the BAM team, the investment team, is hard at work doing that due diligence, and is looking forward to presenting the results of that due diligence at an upcoming at the appropriate time at a trustee meeting. Whether it's an executive committee or a full board, I don't know what that structure is like. And then one thing I did want to flag, and Sandy and Donald, you and I had spoken about this morning, that I want to make sure we figure out the right way to get to the broader board, and tell me if you think this is an offline conversation to have, is that what we talked about was, as we begin this process of due diligencing Base 10 and then move forward on a broader discussion on how to ensure over the long term that there is more specificity and sort of unique opportunities for BERS, that we're sort of pausing on any other individual investments. And I know the trustees have voted on for Centir or whatever, so there is a process to sort of make sure that folks are aware of the pause on that contracting process for the time being. So just wanted to flag that.
Thank you, Alex. Any other questions or comments?
Yeah,
So
this is Tom. Go ahead, Donald. Go ahead.
No, I just wanted to say, yeah, my concern, as Allison said, my concern was that the board had already voted on first Centir, and I didn't want to set a precedent that once we vote on something, that it can be put on a hold or stopped or anything once the board has said yes. And so in our conversation, we spoke about coming back to the board if that's a need to do so, but that was my concern with that. First Centir being a concern, hold on anything else. If that is the discussion that we have, that is fine, but first and tier, we had already voted on it. So just to add context on what Allison said, that was our conversation.
Thank you, Donald.
Hi,
Tom?
this is Tom. I actually share Donald's concern in this, right? Like, if we have already voted to approve something, I have no issue with future items being set up in such a way where that collaboration exists. But for items that we have already voted to approve, we should not be in a position. I think it does set bad precedent to put anything that we have already voted on hold. So I do share Donald's concern, in this particular matter.
Yeah. And hi, this is Greg.
Hey, Greg.
Yeah, I just want to also voice my concern as well. That this just doesn't set the right precedent. So I agree with both Tom and Donald that this is, when I heard that, I was a little surprised that the board takes an official vote and that somewhere there's some reason to put a pause on something that we already voted on is a concern for me.
If I may, Donald, Greg, and Tom, definitely understand your concern on that. I would say one thing that makes me a little bit less, I guess, say worried or kind of, I guess, can alleviate some of those concerns, I believe at least, is that, as a public market manager, the contracting like if this was a private market and there was a fund close that was coming up with a deadline, I'd share your concerns entirely, and I do think we should have that broader discussion. Given that First and Tier is a public market manager, and we had kind of anticipated, even with the selection, having a bit of a lead time or kind of a longer runway. That I'm less concerned that we're going to miss out on any particular opportunities. We're not market timers, absolutely. I don't know if you guys have seen what global markets, equity markets have done, but strictly international space. So we hear you, and obviously we'll have these conversations. But at least from a market perspective, I do want to differentiate between a public and a private market recommendation, given that they do have we typically have much longer lead times anyway for the public market implementation.
And Antonio, quick question, and I apologize because
No.
wouldn't it have been possible to loop in the board to any possible pause that would have been necessary?
So I don't want to say pause being necessary. So I guess the other
If
side,
we would have been consulted and said, look, this is something that, based on what you're explaining, we need to do, at least the board would have been, because it's the first time I'm finding out about it.
absolutely, you're correct about that, Greg.
If the board wants to proceed, the board has that option to proceed. That's the board's prerogative.
Mm-hmm.
Right, and this is Tom. I think that the fact that we've already voted on it states our intention to proceed, right? So again, I'll restate my opinion that if this board has already voted on an item, then that item should be dealt with expeditiously, and any future item, if it's necessary to look at what a different type of collaboration with BAM is, I would be completely open to that.
All right, here it's up to look. At the end of the day, Daniel is correct that it is up to you all. You have the decision. Like I said, I think, yes, I think the ordering of and I'll actually get back to another point that Greg made around the kind of the overall pause. Look, at the end of the day, we're all in the system together, and we want to see if we can, work together given the very unique governance structure of New York City. And so that's from our perspective. It was if our partners in all of this wanted to in earnest have this type of discussion, we've been working on this for 4 years, Greg, over multiple administrations, and the degree to which if we're getting, at least from my perspective, we're getting in earnest an administration that says, hey, we actually want to look at this and work with you. I don't mind. I think having that particular discussion. And so when it came to discussing about a pause and bringing you new recommendations, it was really saying, hey, if this collaboration's for real, then it would help us all. Again, we've had instances where that wasn't the case. But I think Sandy, Daniel, team can tell you, we've been burned by that before. I think from our perspective, we wanted it to if this discussion's for real, we wanted to show in good faith that we would be willing to have that discussion. That's really, I think, where I came from as a director. You are correct that a much more fulsome discussion should have happened.
Antonio, it might be helpful if, Allison as well, maybe next week we can get together and go back to the board with a timeline on when we'll have done this agreement between us and BAM and how to proceed, so we can tell the board by X date we'll proceed forward. I think maybe having this open-ended is also problematic.
I think I think that makes total sense, and commit to that. My only flag is that our new CIO, the new CIO for all 5 funds starts on August 1st, and I don't know if any of the trustees were on the interviews with the various candidates, but the question of whether he has any opposition to sort of deals and investments that are fund specific came up very specifically on those interviews, and he very specifically responded, no, he has no problem. He thinks each fund has its own, every single fund as an individual has its own needs, should have its own portfolio, etc. Understanding risk, like all of the different factors that go into that. And that was, to be perfectly blunt, one of the reasons that, he was selected. So I would want him to be part of the process because it's really his team that's doing the work, not me, to sort of set that time frame up. And he starts August 1st. So if that's something we could come back to the board with at the September meeting, I think he probably needs a couple weeks to figure out where the bathrooms are, So that would be my only request. And in the meantime, the base 10 work is moving forward and all of the other work is happening.
Hi, this is Tom again. I guess I keep ending up in the same place, right? Like, I can appreciate everything that's being said, right? I just do not believe that any decision that we've already made, right, needs to be considered as part of that, right? Like, if we have not made a decision on something already, good, I'm fine. But any decision that we've already made should not be part of any of this particular discussion.
So let me offer that as staff, we will continue to press the Bureau of Asset Manager and Allison and the Controller's Office for closure on First and Tier. And, we work for the trustees. It is not completely clear to me, Tom and Donald and Greg and Nick, that it would have happened much faster anyway. Recall our frustrations with BAM on administration of contracts. This is going to be a slow process in any event. So, Allison, I guess we'll lean into this as soon as we can, and we'll see what the outcome is.
Yep.
Yeah, and to that, Sandy, part of the timeline, can we get a difference in timeline on us voting and it being executed as is, and then what it looks like with any type of hold? Because to Tom's point, that's where my concern actually came into. I just don't like setting the precedence of something that we vote on as trustees being stopped or held or anything like that. And so if that's not what we're doing and the timeline looks the same, then to Tom's point, something being held on that we voted on, I don't feel too comfortable with that versus us talking about future. That's fine. Us working together, I'm all for it. But something that we already vote on, I just think the precedence and the look of that is not good.
So we'll commit to providing trustees an analysis of what the typical contracting period is once trustees have made a decision. I'd have to tell you anecdotally, it tends to take months. So Antonio, we'll sit
We
down
will
after this
absolutely, we will
and
sit down and discuss. I think there's a way to make all this work.
yep. And to report out on that at the next board meeting or the next executive committee meeting, whichever comes first. Well, we may not have it ready for Monday, so
We're not gonna have it. Don't worry.
yeah, okay. The next executive committee, in all likelihood.
So,
But-
does that mean that right now the decision that we've already made is being acted on?
I would say not right now, it's not being acted on. We can't, from our position, we would defer to the controller and to Bureau of Asset Managers, general counsel staff on the finalizing the contract with First and Tier. It's not a complicated contract because it's a separately managed account and there are standard formats for that. But our experience over the years, Tom, is that these things tend to take a few months.
Thank you. I think I just say it because, or I keep asking it that way because there's an understanding that, the approval of a particular investment is not just the investment, but it's the process by which that investment happens, right? And, I just want to make sure that, if we voted on a particular item, that we did that with an understanding that we're voting to approve a particular investment and that investment is going to be carried out in a particular process. And if the process changes by which that happens, or needs to change, right, then it should be, that should be the board's decision. Like it shouldn't be, well, the process changed, so we want to put everything on hold while we figure out what the process is. And that's my concern.
No, there's an established process and we'll pursue that process.
Thank you.
Thank you. Like I said, we'll keep you updated on the broader discussion as well. So the next item on the agenda, first, let me note for the record that Benjamin Schoenbeck from the CFO's Office of the Department of Education is in attendance as well. The next item on the modified agenda is the preliminary performance report for fiscal year ended June 30th, 2022. So give me a moment to share my screen. Please let me know to see it. Can everybody see my screen? All right, good to go. Ooh, the rain is coming hard. Right.
Crazy out there.
Yeah, I know. All right, good to go.
And I'm sitting in my car right now.
So one of the things that I am very happy, there's actually not an asset manager or a manager recommendation on the calendar for this month. So I think today's presentation is really going to focus on what I think we call the forest rather than the trees. And so it's going to be divided into three parts. The first big picture items on performance, funded ratio, asset allocation, our annual plan and goals, and some outstanding questions that I think we need to have the board answer over the next 6 months. Then Siegel Marco Advisors, Vanessa Vargas, will give an asset manager performance heat map. Siegel Marco used to do this in the past. Vanessa and team are bringing it back to see where our active managers are adding value to the portfolio over the long term. And then Deputy Director of Investment Strategy, Salou Mehta, will go over the implications of a bear market. Because as you'll see in a moment, this is going to be a very unusual meeting for us. If you've been in either in New York City for a long time or on this board for a while, you'll know that this is really the first negative fiscal year return we've had in some time. So for the fiscal year ended June 30th, 2022, there are preliminary results of the portfolio is down 9.24% for the fiscal year. That's compared to a PME, so a public market equivalent benchmark of minus 13.51, and a U.S. reference portfolio that's 70% U.S. stocks, 30% U.S. bonds of minus 12.60%. We'll keep it, kind of let you know the rationale. The reason for that is really private market portfolios have not been marked down to the same extent as public market portfolios. But as a result, our trailing 3, 4, and 6 year numbers, all in comparison to these two benchmarks, the public market equivalent which takes the equivalent public market to our private market investments, and the U.S. reference portfolio, 70% stocks, 30% U.S. bonds, outperforms over the 3 year. Reason I chose 4 years, 4 years 2018. So this is my anniversary of coming to BERS. A little bit behind the public U.S. reference portfolio, but still above the public market equivalent. And then over the trailing 6 years, and again, I stress the reason we use 6 years because that is the time period by which the actuary rolls in market returns for contribution purposes. So, from our vantage point, 6 years is kind of our mini market cycle. The trailing 6 years above our 7% actuarial return rate of 7%. So we're at 9.2% for the preliminarily for the BERS portfolio versus a 7.19% for the public market equivalent and 8.69% for the U.S. reference portfolio. This is a story, and I think I've told this story of pretty much every single meeting, every quarterly meeting that we've had, that U.S. equity returns have far outpaced returns of every other public market asset class. And so this is for the major public market asset classes that we invest in: U.S. equity, developed markets ex-U.S., emerging market equity, core fixed income, high yield fixed income, and U.S. TIPS. And I think there are two stories. I was telling for the past 3-4 years, been telling one story. There are actually two stories on this bar chart for you. The first one is just how much U.S. equity markets have outpaced every other market. So this U.S. equity represented by the Russell 3000. Over the trailing 5 years, the Russell 3000 has returned annualized 2.6%, even with the close to 14% drop in the last fiscal year. And over the trailing 10 years, 12.5% annualized. If you see every other market has come nowhere close to matching either our expectations or the U.S. equity market as a whole. So you see over the past 5 years, the second highest returning annualized asset class is actually U.S. TIPS. The two major equity markets of developed markets and emerging markets have returned under 3% annualized over the past 5 years. Even in looking at the trailing 10-year period, developed markets have returned only a bit above 5%. And again, EM equity, emerging market equity have returned 3%. In fact, you see high yield debt has actually done better than the emerging market equities. And bonds, of course, have returned to less than 2% over that time period. But there's another story on this bar chart, and that's the story around U.S. equity and core fixed income correlations over this past year. Probably heard it if you watch any type of financial news that this was the worst 6 months for financial assets in certainly in memory, but it's certainly going back 50, 60 years. The U.S. equity markets represented by the Russell 3000 returned negative 13.87%. Core fixed income returned a negative 10.29%. I don't think I'm exaggerating when I say that our entire kind of portfolio construction thesis is in kind of strategic asset allocation is built around a negative, especially on the downside, a negative stock bond correlation. I mean, too early to call whether this is necessarily a change of regime, and we're certainly happy for positive correlation when markets are up. But to have core fixed income decline to that extent while equity markets decline, that means essentially we had no real buffer. And that is different from the more recent crises in financial assets, where the core fixed income, particularly U.S. Treasury, is seen as a safe haven. But with interest rates rising and equity markets falling, it's really, I think, worst of all worlds for our financial assets perspective. And so as a result, we looked at what we believe are our pro forma funded ratio. So just as is, if basically the past from a liabilities perspective, from a inflows to the TDA perspective, all kind of remain the same. Our estimate right now for the funded ratio is 100.74% at June 30, 2022. That's a 21% drop from fiscal year 2021. Obviously, 100% funded is still a fantastic place to be, but it's a 21% drop from the previous fiscal year. And I'll get into a minute on how we go from a 9% asset drop to 21% drop, a decline in funded ratio. But said again, 100% still a fantastic place to be. The market returns of 2021 has given us quite a bit of cushion for any future downturns. Another issue, I think this is a big one, is that with the decline of public markets, we are now at target in private equity and real estate. In fact, quite a bit above target in private equity at 2.63%. Had a gangbusters year last year, no real kind of markdowns yet. We'll see where Q2 valuations come in. We are also slightly above target in real estate by 24 basis points. We are still well under for the other private markets. We are a little bit less than halfway there for opportunistic fixed income and infrastructure. We're maybe a little bit less than 3/4 of the way to our target. Importantly, this is primarily because of declines in public markets. So you see public market equities, public market fixed income are all below their targets. We're slightly above in cash. But really, this is a more of an effect, a consequence of the denominator effect of the declines in public markets and the without write-downs in the private markets than kind of getting out over our skis when it comes to pacing. In addition, folks who are on the board at the beginning of each calendar year, we walk through in concert with the Bureau of Asset Management our annual plans for public markets and private markets when it comes to commitments, pacing, and searches, as well as other internal projects. We are on track to meet roughly half of our annual plan goals this year. So in public equity, the two major goals, international developed ex-US search and global listed infrastructure search. The international developed market search is still in progress. Do not believe that it will be completed and a recommendation will come to you before the end of this year. The global listed search, obviously, we talked about that. We sent a recommendation to the Board of Trustees that was approved last month. Public fixed income, the emerging manager fund of fund search was approved in February of 2022. That was the major goal in public fixed income. That was completed alongside the other systems. In private equity, we had annual plan goal was $335 million in commitments. We're at $190 million. We're more than halfway there. So I do think we're on track to meet the commitment target that year. Real estate, same thing, $200 million in commitments. We've already made $175 million. So we really are only looking at one more manager in real estate for the rest of the year. Opportunistic fixed income, private credit. This is the place where we have the most ground to make up. And this is probably the place where we have our portfolio construction in our investment policy statement is the most different from the other systems. As you recall, we didn't start our program in this asset class until 2020. The other systems all started this program in 2011 and have a bit more, want to take a bit more risk in that program than we do. So we've only made $40 million in commitments in this versus 215. So I do not think we'll be on track to make our commitment target this year. Infrastructure, this is NOAA with an asterisk. So we have $70 million in commitment, so a little bit less than halfway to our $175 million annual plan goal. However, this is a symptom of how we track vintage years. The last investment that the board approved in 2021 was for the other systems is treated as a 2022 investment. In our tracking, we treat it as a 2021 investment. So using the tracking that the other systems use, I think we would hit target for commitments of the year. So this is no with an asterisk. One change from your packets. Our major kind of policy or kind of internal, one of our major projects was the variable TDA RFP issuance. I believe at the time we were working with internal audit and a task force before issuing. I did not, I put no that we would not on track to release. I think now we actually are on track to release the RFP by the end of the year. And then finally, other projects. The board approved a project with KBF Global, and a pilot project on ESG in private markets. We're finishing contracting there, and so I do believe we're on track to complete that particular project. So one thing I want to discuss before I turn it over to Vanessa I think there are 3 outstanding portfolio questions for the end of the year. One is, how does a 9% drop in assets equal a 21% drop in funded ratio? And the question is, what is a long-term solution for our commingled QPP and fixed TDA plan, which you'll see in a second? Volatility and the importance of the developed market equity search. From our perspective, what does this really say about how we spend our time and, kind of going forward? And then should we reduce the number of managers or reduce the minimum allocation size in private markets? So our estimated change in funded ratio has 4 major components: the asset return, the guaranteed return and inflows to the TDA, the growth of the present value of the future liabilities, and other items, mainly receivables from the city for contribution to the pension plan. So our asset return, and to show this is for simplicity's sake, I'm making these additive. They're actually more multiplicative, but additive gets us close enough to our actual change in funded ratio. So I'm simplifying this a little bit. But starting with an asset return of essentially 9.25% down for the fiscal year, the guaranteed return plus the inflows to the fixed TDA is another 11.25%. So as you know, the fixed TDA has an 8.25% guaranteed return. But in addition, participants, and I'm a participant in the fixed TDA, so I'm including myself here, we're continuously contributing to this particular plan. And so inflows are around 2 to 3% every year. So that's another kind of addition to the change in the asset return and the funded ratio. Over the past 5 years, the growth of the present value of our future liabilities has been about 4.5%. So somewhere between 4 and 5% on an annual basis, tracking over the last 5 years, 5 to 6 years, I should say. And so that's adding another. So as the assets declined and guaranteed assets are going to the fixed program, future liabilities are increasing, and so that also adds to kind of the changes in our funded ratio. Another item, 4%, that actually adds. So the corpus of that the assets that are invested are not the only items that account for our overall funded ratio. We book receivables from the city if they have additional contributions to make. Also some assets from securities lending, but really receivables are the largest portion. And so that actually increases our funded ratio versus the assets that you'll see in State Street. So ultimately, that gets to a minus 21% change in the funded ratio, and really that brings us to, I think, some very big questions for us, because we estimate that the fixed TDA is now 28% of total assets in the overall corpus that we invest alongside the QPP. So the growth of this fixed TDA as a percentage of total assets will have an increasing effect on our funded ratio. And so I give an example here, back of the envelope calculations, but for a 3% inflow for fiscal year 2023 is roughly equivalent to about $66.6 million. So we expect a 7% return assumption on the total corpus of the assets. That's equivalent to about $555 million. So that's nearly 12% of the return. So the inflows for the fixed TDA are nearly 12% of the total return expectation that we have on an annual basis. To give it a, that's actually equivalent to our return assumption for developed market equities. So the inflows, and this is not counting the guaranteed return, this is just the inflows. So 3% inflows equals how much money we expect to earn from developed market equities every year. And so, you know, and our inflows tend to fluctuate somewhere between 2 to 3% every year. So I think in the big picture, only U.S. equity and private equity will contribute a higher return than the inflows from the fixed TDA. I'm not saying we have a solution here yet, but what I am saying is that increasingly, the inflows for the fixed TDA combined with the guaranteed return will have a larger effect on our overall funded ratio and our outcomes than the, you know, almost every other asset class decision we make, except for U.S. equity and maybe private equity. It's a big question. And it's part of the reason why we had always kind of attempted to have a bit of a different asset allocation and portfolio construction than the other systems, because, and you know, look, I believe that our beneficiaries and the folks who participate should continue to be able to participate in this, but it does mean that we have to answer and kind of think about these questions as we're constructing our portfolio. The second big question I think we have is volatility in developed market equity search. And again, this is
Antonio?
really, oh yeah, go ahead. Sorry.
Sorry to interrupt, but Tom raised his hand to ask.
Oh, sorry. Go ahead.
Go.
I can't see anybody with the thing, so thank you for stopping me on that.
Hi, Antonio.
Yes.
I got a question. A few slides ago,
Yes.
you had a slide up about like investment targets, right?
Yes.
I guess the question I have is, yeah, that one.
Yeah.
The question I have, and sorry for the rain, it's kind of like
No.
raining all over the car here. But, the question I have is, this is our kind of annual, these are our annual goals.
Yes,
I'm
annual
really
goals.
interested in knowing, you know, right now, what our total exposure is in these markets, right? So what is our total exposure in, let's say, private equity and real estate, right?
Absolutely.
Because I think for me, one of the things that I want to understand better is, if we say private equity, for example,
Mhm.
like, what does this look like? What does the portfolio of investments in private equity look like? I hope I'm making sense here, because, you know, we talk about eggs in baskets, right? I kind of want to know what the eggs are, right? Or who the eggs are, so that I can understand or have a better understanding of the investments that we make, and what the types of returns that each investment would look like. And again, I know that there are lots of them, but I would really like to really understand, because, and I guess I asked the question for this reason, right? When we say private equity, what are we saying, right? Because I see private equity and then I see real estate. And what I know is that you have private equity firms that invest in real estate,
Yes.
right? But for the purposes of our investment, it wouldn't be considered a real estate investment. It would be considered a private equity investment, correct?
No. So for instance, to give you an example, so right now we have about 922, our exposure to private equity around about $922 million as of 6/30, 2022. So it's 11.63% of our entire portfolio. For real estate, we are at 8.24% of the portfolio as of, so that's about $650 million is our total exposure. But if it's classified as a real estate investment, so let's say, we'll give you an example of Brookfield, right? Brookfield, we invest in both infrastructure and real estate. And, if it's them buying, kind of commercial real estate, industrial real estate, retail, hotels, that would be classified as a real estate investment. So, or KKR, probably the best example. We have, investments with them in companies, which again, most of our private equity exposure is leveraged buyout. So large buyout of, kind of small cap, mid cap companies. They're large in the private equity world, but they're small in the, kind of public market world. But then we also have investments with them in real estate as well. So we have real estate in America and in Europe. They're typically buying large blocks. They're buying portfolios of real estate in this case. We can get into more detail though. I'd love to show you within our portfolio analytics platform, so we can show that. And maybe we have time. I can, I'll certainly do it offline. But those are our total exposures. These are incredibly well diversified, right? Portfolios. If you're with the largest managers, they're going to be incredibly diversified. So we think our large manager of real estate currently is LaSalle. They're going to be an Odyssey type of fund, so like kind of the major open-ended fund. So they're going to have, they're going to hew close to the overall market in real estate. So multifamily, industrial, office, hotel and leisure. So they're going to track the market in that way. Most of our managers have been certainly underexposed to retail, and so I think you'll find, but I'd have to go into detail on a particular manager at at a later date, even later today or tomorrow. But I'd say you're going to find that it's we have a broadly diversified portfolio in each of the asset classes.
Thank
Maybe
you.
a slight.
I would
Oh, sorry. Go ahead.
appreciate that. Yeah. No, I would really appreciate that, and I guess I asked that question, and will appreciate the conversation, because things that always front and center of mind is not just the impact of the investments we make on our members' ability to retire. What do those investments look like in their everyday lives, right? So are we investing in companies that are buying up residential estate and then renting back that real estate to our members at rents that they can't afford, right? Or they can't afford for them. Buy homes in their own neighborhoods because they're owned by these firms, right? And I was told that's why I asked the question, because I really want to understand what the investments themselves look like and the impact of those particular investments on the everyday life of
Absolutely. So let's follow up right after this meeting, and we can have a more detailed conversation. Be very quick on this one because I know we still have Vanessa and Salil to go over their aspects as well. Just want to say that when we're thinking about big picture, about outcomes again, if you look at the past 6 years, 3 asset classes account for 98% of the volatility. So kind of the variability in our outcomes in the in our portfolio: U.S. equity, international equity, U.S. high yield debt. International equity has the highest marginal tracking error active risk. I'll define that as essentially saying, where are we taking our active bets? If we're going to look different than the benchmark that you have for the portfolio, where are we going to look different and how we're going to look different? International equity has the highest what's called marginal tracking error. Basically, it's the most on a standalone basis, the highest kind of differentiation between the benchmark. But it's smaller than U.S. equity, so it's the second highest total contribution. It's certainly disproportionate to its weight. So international equity, we are entirely actively managed. U.S. equity, we are 85% indexed. With the obviously the divestment of fossil fuels, it's a little bit different, but essentially we were in it with an index provider. And that's really important because we take a ton of our active risk, a ton of our bets in international equity. But we have divested from fossil fuel reserve owners. Our value managers typically have meaningful exposure to energy. And so as we're thinking about portfolio construction, does it make sense to have a dedicated value manager in the portfolio when we're saying you're essentially saying you cannot invest in certain areas that are part of a larger part of your universe. Again, not saying this is not a kind of a normative discussion. At the end of the day, the board made this decision, and we are acting on that decision. but it does mean that our universe might look a little different, and which manager is best positioned to outperform may look a little different than it has in the past. So that's just a consideration I think that the board should be thinking about as you're getting recommendations for overall portfolio construction in such a critical asset class. I wanted to show this real quick. This is kind of what I said in the top left corner, what I said before. These three asset classes, U.S. equity, and all this comes from our CAISA platform. U.S. equity, international equity, alternative credit make up the vast majority of our, again, 98% of the annualized volatility over the past 6 years. So essentially, if we're going to outperform, underperform on an absolute relative basis, it's really those three asset classes are going to determine it. The upper right hand, this shows why, if we're thinking about how we look different than our benchmark, why these asset classes are so important and why the parking places are so important. Because this number, the 15.505 annualized tracking error, is primarily because we have assets in the parking places. And so when money is in the parking places, and particularly in volatile asset classes like these, that means that's going to over-determine when we look different than the particular benchmark. And so that's why I think over the past 2 years, you've seen us kind of harping on what to do about the parking places, because if we're investing more in U.S. equity and more in international equity, it's going to have a large variability on the total outcomes of the fund. If we look at it just from a public market perspective, however, obviously tracking error is going to be a lot lower because, again, our largest asset class is so indexed. So it's a little bit more balanced there. But public market equities, international equities, is 32% of our tracking error, or 25% of the tracking error there, and it's really only 16% of our target. To give you an example of why it has such an outsized effect on our active bets versus the broader benchmark. And really, if you look at developed markets over the past 4 years, one manager has really determined whether or not we outperform. So where we have our active bets against the benchmark is fairly different. 85% of our active risk on an annualized basis over the past 4 years has been with Bailey Gifford. Bailey Gifford does well, we do very well. Bailey Gifford does poorly, we do poorly. I'm not saying that's a good or bad thing. Volatility and annualized tracking error by themselves are not this is not saying that they're not bad in of themselves. Actually, I think volatility for an investor like us in general can be very good. Tracking error can be fine if we are comfortable with the managers. Active risk can be fine in that capacity. Just to let you know that is something that we do need to understand, though, what is determinative about outcomes. And this slide kind of shows you kind of where where outcomes are truly generated in our portfolio. And so the developed market in equity search, ex-US, is a very, very important search for our portfolio. Going through the process with the Bureau right now alongside Siegel Marco, so that portfolio construction is going to have a very much an outsized weight on the overall outcomes for our portfolio. Finally, before I turn it over to Vanessa, the last question, how should we address private market pacing? So we are over targeted in private equity and real estate. Real estate's only by a little bit, private equity quite a bit. Infrastructure and private credit, we are still well below target, so we don't have to think about being worried about going over target and breaching anything with those particular asset classes. But and if we were in any other state or almost any other state, this would not be as much of an issue. But we're in a state that has a basket clause. There's enumerated investments, and so that does. I think we have an additional consideration. I know, certainly BAM's thinking about this on how to think about pacing through the rest of the year. Do we slow it? And all that kind of entails. That's either lowering the number of managers or decreasing our commitment sizes. Obviously, we have a minimum in our IPS right now. So those are just kind of big questions that we have to think about. Or do we keep on our pacing targets and risk reaching the basket? And part of that for me is that hopefully markdowns will start coming, right? And so in this case, obviously there's some short-term pain, but I think long-term being able to keep on our pacing without having that particular consideration is incredibly important. And then really public markets, unless things go absolutely bonkers over the next few years, you can hope that public markets will revert at some point. And we don't want to be in a position we were in right after the financial crisis, which is you stopping the pacing because we were both worried about basket considerations and about fundraising. And so then we ended up far behind our pace in the private market asset classes. And so it's a delicate balance. I know it's keeping up the asset class heads at BAM, but it is just something you have to think about. And finally, will the basket clause legislation save us, right? Like that'd be the best outcome, right? That ultimately the basket clause increases. We don't have to worry about that to the same extent. But it is something to think about because, I think particularly in private equity, given that valuations, at least on paper, are still very elevated, every other asset class, we still have some room. But it's just, I think the final question we have to think about through the rest of the year as we're formulating the strategy and making recommendations to the board. All right. So that's the end of me. Before I turn it over to Vanessa, any questions? I know it's a lot to discuss, a lot to give, but Tom, do you still have your hand up? But
sorry, I'll lower that now.
okay, no problem. Thank you. So the second part for us is that Vanessa is actually going to go through. Let me see. Open this up. Let me open up other applications. Give me 1 second. A presentation that we've done in the past. I think it is one that I think we want to continue. Which is looking at our active managers and seeing their performance over the long term. I'll increase the size a bit. 1 second. But yeah, Vanessa, the floor is yours.
Thank you. So as Antonio mentioned, we had in the past shown this in prior meetings. However, I think none of the new trustees have seen it. So let me explain a little bit of the data that you're seeing. This is preliminary returns for your managers. For the trustees that attended yesterday's meeting with BAM, the custodian statements are not available yet. So what we're doing here is the longer term numbers that you see here are actually coming from your custodian statements. The shorter term, so the last quarter, we used CAISA to supplement the data. So we're able to show you this today. And what it does is you have the manager, then you have the allocation as of June 30th per CAISA, your target allocation to each of the major asset classes per the IPS. And then when you look at the columns that are color coded, you're looking at the number that is there is literally the return of the manager minus the benchmark. And then all the way at the far right of the page, you're actually seeing the actual since inception return of each of those managers. So as you can see here on a longer term basis, and if I concentrate on US equity, for example, Antonio just mentioned you have some active management, but it's not the majority of the US equity portfolio. The majority of the US equity portfolio is passive. But the few managers that you have there, Wellington is the one that has the highest allocation. Wellington has a growth tilt. What we've seen is growthier managers have underperformed the benchmarks. A lot of it has to do with some of the technology associated with the companies that they have in the portfolio. So Wellington has underperformed on the shorter term basis. So that 1 year return, you see that large underperformance versus the benchmark on an absolute number. Just to give you an example, Wellington is down 25% for the last 1 year. So that's why you see the 1, the 3, and the 5 underperforming. If I move on to the non-US equity side, and this is developed non-US equity only, and that's where we're talking with them about the search. Right, I know that the search is moving forward. They're still reviewing fees from the managers that have submitted proposals, but we're not there yet in terms of discussion of a more shorter list of what may look like from a portfolio construction basis. But you have 2 managers here that have the largest weight: Bailey Gifford and Spruce Grove. Bailey Gifford, again, on the growthier side, has had have underperformed for the last year by 40. Their return basically is down 45% for the 1 year period, and a lot it has to do with their technology sector. They have 26%, almost 26% of their exposure in technology. Companies that you may have heard in the news, like M3, Spotify, HelloFresh, Mercado Libre, which is the Amazon of Latin America. All of those companies have hurt on a one-year basis or detracted value from the portfolio. Also, not having anything in energy has also hurt the portfolio, even though the allocation to energy is small on the non-US growth side. Spruce Corp has also underperformed for that last 1 year. And again, no energy because of the divestment prices. They have a lot more in consumer discretionary, and there's really weak industrial and consumer spending going on in Europe in general. And that has hurt the portfolio. When you look at the global equity, we have two managers. It's an outside of the policy investments, so, which means we divide their allocations between US and non-US because they can invest in both, and a little bit of emerging market as well. Really, the manager, Morgan Stanley, has really hurt for the last year. They have underperformed, and they tend to be more growthier, and that's part of that underperformance. On fixed income, a lot of the managers are, negative versus the benchmark, and some of your actual managers that we added in the last year and a half are negative, and that has a lot to do with timing and when we added them to the portfolio. Our goal is to continue showing you this returns on a quarterly basis, and we will continue to update it using custody statements when available, and then fill in gaps from CAISA so you're able to see it a little bit closer to the quarter rather than wait until the August meeting to be able to show you some of this. And let me stop and see if I can, if there's any questions for me.
Any questions for Vanessa on the heat map? So thank you, Vanessa. So we'll make sure you get a copy, and you'll get a copy of all of these, the presentation and all of this at the close of the meeting. Finally, Salil, our Salil Mehta, Deputy Director, is going to walk through the implications of a bear market. This looks beautiful. Implications of a bear market, because, again, this is the first time we're reporting negative returns for you all for the fiscal year. Because it's an unusual place for us, but it's not unusual in the history of markets, it's just unusual for us in the meantime. So, Salil, the floor is yours.
Thank you, Antonio. First of all, can everyone see my PowerPoint screen? I just want to confirm. Okay, good. So today I have two presentations. The first one is I'll spend about 10 minutes talking about market crashes and what that implies about our pension. And it's actually a two-step analysis. The first part, which I'll do today, is just qualitative. I promise not to put out any numbers, but sort of what the appetite for a future analysis, which will actually flush out the numbers a little more carefully on what I'm going to describe here. And then after that, there's a larger presentation I have on just the basket clause analysis. So I'm going to just proceed, and if any questions, just feel free to interject.
Actually, before you
Yes.
start, Salil, I don't know if we've actually made formal introductions for trustees for Salil. Salil hired in the last few months, very strong statistical financial analysis, worked for Treasury during the TARP years, statistics professor at Harvard and Princeton, occasionally, and lecturer. So Salil is one of the smartest people we have working for us.
You forgot that we worked together, actually, Sandy, at PBGC. We're running two different departments of that. That's how we met, and so it's
Yes.
great to be here. And thank you. And yeah, no, this is a certainly enjoyable work. It's just an odd time given what we have here with when you have what's essentially large market crashes, and it's something that sort of shows up. And what's sort of important that I sort of want to articulate is that they come in different ways. They sometimes come spaced across time, sometimes clustered, sometimes different asset classes at the same time. Sometimes they're fast to recover, sometimes not. Bear markets has a very common definition of being a 20% or worse decline from a high. And that's something we generally see in equity markets. We saw it obviously in 2020, we saw it in 2008, we saw it in the dot-com, we saw it 1987. Bear markets are a little more rare, but they do occur. There was a big bear market in 1994. And the one thing that's sort of a common thread in that is that the bear markets in bonds and stocks generally don't happen at the same time if you look at history in a certain way. But they do certainly have large drops, even though they may not be bear markets at the same time. We're seeing that now. We saw that when I was working in TARP and other things. It just never hit 20% on bonds. And if you remove the coronavirus market crash, generally they're a lot more protracted, and they have a similar rhythm where for the initial quarters you see a fracture in the market, and then you get a flush out in subsequent quarters. Now, we've had a couple quarters where the markets have fallen, and it's yet to be seen whether they'll recover and in what way, or is this just a fracture before something larger? I'm not going to speculate, but these are the sort of the patterns from the past. And sort of some of the uncertainties to be humble about sort of going forward. So I'm going to talk a little more about sort of what that means and funding ratios and some complexities in our modeling. So financial market data in terms of a time series is some of the longest in the world. They go back centuries. However, as humans, as investors, folks who are managing pensions and others, we typically look at recent history and form a bias of what we think will happen in the future because that's been our sort of experience. And in that history, going back a couple decades, what we see in these market cycles is a pattern of equity markets that recover from bear markets to new highs in the US, not necessarily in other markets always, and yields that generally recover, so to speak, to lower lows, and rebounds that have increased, that have happened in increasing rapidness, which is very unusual in the overall history. But if you look over the last few decades, you kind of see that pattern, and I think that's been grounded in investors. Very difficult to time markets, obviously. There's obviously a search for yield, and therein lies this conundrum of sort of how to be most optimal in through a business cycle in how you invest for a longer term liability and a pension. Two quick things on here is the topic of having ever complex constraints as you rise up in a bull market on what that means, and then also some challenging aftermaths that repeatedly occur in pensions during bear markets. So the first thing is that, and we'll talk about this sort of in the basket clause analysis as well, but you have an investment optimization model, which has traditionally relied upon a small number of quantitative inputs. When you continue to overlay additional constraints to any optimization model, whether it's a risk one or something else, it does weaken the actual result and causes things to be somewhat suboptimal. And these could be non-quantitative constraints. It could be just biases in a manager wanting to emphasize or de-emphasize a specific sector, geography, type of manager, that sort of things. And it's well disclaimed in a lot of larger investment managers that this is a price to pay to retain values and so forth. And the reason I mention that in this case is that suboptimality generally shows up in these bear markets. And so if we haven't seen them recently, we'll see it over the course of the next, over the course of the upcoming business cycle. In terms of pensions, generally, over recent business cycles and sort of broadly across the country, uh, but having a bear market means your assets have obviously fallen. Liabilities generally fall, but not by as much, which leads to a degradation in your surplus, underfunding situations, which generally cannot be made up only through just smarter investing. Risk models have not typically caught up with changes in bear markets, and we've seen a few of these bear markets now, over the last couple decades. And the general pattern is that contributions, at least in public pensions, need to rise at the same time that you're having tax revenues fall from both the capital gains of individuals that they contribute back to taxes, and then also to the degree that the bear markets are associated with recessions, you also see income tax drops happening at the same time. You also have expectations for real benefits for retirees get strained, and especially for active employees, some of them are in a position where they may be stressed due to the recession, due to the bear market and other things, and compelled to work longer. So it's a very complicated aftermath that sort of still has to, perhaps play out, and then also the range of uncertainty and sort of where to go from there. I'm going to pause briefly now. There's a couple more slides. If there's any questions, I'm happy to take them. Okay, so in terms of funding ratio, the direction of travel for pension funds during this time is that their funding ratios decline. They declined by different estimates depending on when it's reported. There's a standard error around that estimate, generally around 5%. And then when you look at what the scenarios are, at least in the case of BERS, and this was sort of mentioned previously, but if you play out what would happen with assets and then changes to the structure of and composition of the workforce, that there's more scenarios which would play out to the downside than the upside, and you would generally see additional funding ratio decline. I mean, maybe there's a 1/3 chance you'll see another 5-10% drop in the funding ratio. The numbers and those scenarios and so forth, I'll flush out in a future presentation. But that's generally the direction of travel. It's just a difficult sort of environment. It's that's just kind of what happens when you ride these cycles. And one of the things that I'll look at sort of in the future is looking at tail modeling a little more closely. And it's something I've worked on at PBGC. It's something that I worked on the original CCAR stress test, and they do this in large insurance companies and other places. To the degree that we can integrate in the future artificial intelligence or machine learning to more fine-tune the funding risks for BERS, that will be looked at. And then the other point is that a lot of the underlying sort of investment and optimization and risk, a lot of it is uses either normal assumptions, like the normal distribution, and sort of a lot of things are built off of that, covariances, correlations, all these concepts, to something that is a little more complex than that, and then also just more nuanced for the specific needs for BERS. So that's all I had on this. Is everyone comfortable? Any questions before I go on to the basket clause?
So Lil, I just want to make one point on this because it's very
Sure.
important. Thank you for your presentation. I think, and marrying kind of the work that you're going to be doing with kind of our overall strategy and also our overall, to the degree that this analysis necessitates customization. We want to make sure that all of this is based off of the data, off of our unique liabilities, off of the portfolio construction that we create in concert with our advisors. But I think that is to us is the most important thing, that this is going to be based on, like, we have a general framework to how to solve for the general. Our work and the work that we are doing is how to solve for the specific, given, again, the presentation earlier gave around the fixed TDA becoming a larger portion of our assets. How flows, and we think about returns, we're thinking about flows and how those flows end up changing the complexion of our return requirements. And so I really look forward to Salil's analysis on this because I do think it'll be helpful in concert with the asset liability study that Siegel Markle put together and some of the pacing analysis that Axios put together as well. So just wanted to let you all know that that's how that's all going to fit in the framework for our overall strategy.
Thanks, Tony. Should I proceed with basket clause, or is there another topic in between?
I think ready to go, man. Floor is yours.
Okay. So for the basket clause analysis, so I'm going to talk about what it is and some preliminary conclusions from it, describe some of the number of considerations that went into this analysis, and then talk about what changes we might consider in asset allocation. And I have a number of slides and charts sort of at the end that just kind of continue to show this in different ways so it all sort of fits together and makes sense. Even though it's not necessarily making a different point, it's just showing it in different ways. And it's because one chart and one graph wasn't sufficient to do that. So in terms of the basket clause, what this is the legislature has passed an amendment that would allow the alternatives subset of our public pension portfolio to increase from currently 25% to 35%. This is something the governor may sign into law by the end of this year. And the idea here is to discover what we might want to consider kind of if that flexibility were to be provided. Now, the definition of an alternative sort of in the context of the basket clause is this subset that would look at the full allocation to private markets and infrastructure and anything above 10% in international equity, high yield, and real estate. And so I'll talk about sort of what this new allocation, some of the initial conclusions from that. The first is, it seems like from a number of different sort of considerations, the general sort of direction of travel is that you would want to utilize this flexibility, increase the allocation to this alternative subset from currently, it's a little less than 25%, maybe up to around 31%. And there's some reason why it may not go all the way up to 35%, which I'll describe. However, there's always this small flexibility in that additional room, which is important because of the way the markets behave, liquidity, pacing, and other sort of issues. And this is an initial analysis because the there's some additional work that needs to be done on what the risk would be and optimizing that, and that would just take a little more time. And the actual value may change from 31% being optimal to something a little, up or down of that. Now, there were 4 considerations in coming up with the recommendation. The first is that the BERS portfolio currently has 22% of its assets that would be considered alternatives within that basket clause sort of definition. It comes from a superset of 49% of assets that are in alternatives. And the reason you go from 49% to 22% is certain things, say high yield, where you currently have 8% of your portfolio allocated, only gets 0% counted towards alternatives kind of within the basket clause. So it's not literally one to one. That also means that regardless of what number is actually selected, you have a much larger exposure to alternatives in the portfolio than what gets counted. And then the other thing is that you will have non-alternatives that'll have some correlation to that anyway. So, so that's one consideration. The second is I looked at all the different asset classes and where our allocation is versus the market weights and where our current allocations are relative to the policy, allocation policy. Look at what those differences are, as well as the changes to where capital return assumptions are likely headed, where they've headed in the past during over the cycle of market downturns, as well as likely changes to covariances and risk and so forth. I'm putting all that together. So there are 4 different considerations. The topic here is that when you want to take advantage of increasing your allocation to alternatives, some choices obviously need to be made. We're not going to, for example, just increase each of the 6 asset classes that would be considered alternatives by 1.7% and therefore go from 25% to 35%. That doesn't make sense to increase exactly the same amount. Conversely, we wouldn't scale down non-alternatives by the exact same fraction. So there's the optimization model that you'll see will just fine tune exactly up or down and by how much specific asset classes should go. I'll pause right now, see if there's any questions on the setup, and then I'll go into kind of what the asset classes would look like in some charts. Okay, I don't see anyone, at least from my view, so I'm going to keep going. So on the left here, I show that if we only looked at a few criteria, for example, what's allocation relative to the market, what's our allocation relative to our policy, and are we currently up against the basket clause threshold to begin with? For example, if you have 8% in high yield, adding an extra 1% allocation to high yield doesn't really change anything. You go from 8% to 9%, but if it's not over 10%, you actually, it doesn't actually matter. You already had that flexibility. It's just not being used. So taking into account those 3 considerations, which can you guys verify, can you guys see a mouse that's floating around on the screen? Okay, because I was going to use that as a pointer for this in later slides. If you just looked at those simple set of criteria, those initial 3, you would say that, well, of the 6 alternatives asset classes, we would overemphasize things like real estate and infrastructure versus the other ones. It's a very very basic, blunt approach. On the right, I show that if you take into account 2 additional considerations, the flexibility in deducing where the direction of return assumptions will be in different asset classes and the covariances, you get a much more nuanced approach to exactly for the specific asset classes going up or down. You still see things like real estate and infrastructure, but certain things percolate up more down a little more carefully. And if you keep a track of these icons, because they'll show up in a couple slides again, it's just showing things that are directly meant to maybe go up a little more than others. I also wanted to mention this concept of allocation corridor, which was considered in this analysis, and that is that when you establish a asset allocation weight, there's always room for flexibility around that weight, a specific band or corridor, and that's because markets will change, and you don't want to be over sort of emphasizing trading, and that corridor fluctuates depending on different asset classes. You have a little more room in some of the bigger asset classes than others. The reason that was taken into account is because to the degree that you're able to make a change in your alternatives asset class weighting based on the basket clause, and that it does not overly change your current allocation band. If it doesn't go, completely stretching outside the current bands, then that's easier to adopt than one where you're constantly going to be running up against having to make a change and then approving a new asset allocation set of weights altogether. And what I show here now is a little more intuitive, I think, all the different asset classes and where the but by the way, it shows kind of presumed range and then some direction of where we might go. The first thing to note is that the overall analysis looks like you would probably increase your alternatives weight around 800 basis points from 48% of the portfolio to around 56%, which converts to around 700 basis points in just the basket clause alternative definition because of that. It's not literally one-to-one. And this is how that 700 basis points would sort of be spread. You'd see a little bit more coming from real estate and infrastructure, and a little bit less, but insignificantly less, in high yield and private credit. And that's because you're taking into account over 4 different considerations here, and I'll continue to clarify that in future graphs. You also see in real estate and infrastructure, these are very sizable jumps in allocated weight relative to where they are. And if the alternatives portion of the pie shrinks by 700 basis points, the non-alternatives portion or increases by 700 basis points, the non-alternative portion must obviously decrease by roughly 700 basis points in order to make up for things. And that would be somewhat proportionally based on the current weightings in US equities and high yield. So all of this sums together to netting out. But that's probably what the new allocations would look like. I'll pause to see if there's any questions. Then I have 3 more graphs that sort of just show this in different ways to kind of reinforce some of the same points.
So Salil, one of the, I mean, I actually made a presentation this morning about emerging markets equities, and one of the questions I've asked is, we know what the historic volatility is, and we know the historic returns, and the trade-off doesn't seem all that attractive given our performance. And you know, the question is, if you believe in mean reversion, what is the expected mean of international and emerging market equity returns? I think it's actually a lot lower than what we believe it to be. But just anecdotally, I don't know if I would support emerging market equities going up. So
No, it's a fair point, and this one of the things I'll mention is that there were 4 different considerations. One is what you're referring to, which is sort of expectations for future returns, and then other factors about where our current weightings are relative to other asset classes. Antonio mentioned, for example, the high market declines in different public markets, and so therefore they are currently somewhat perceived as underweight, sort of in a market basket. But this can certainly be fleshed out more. The and you know, it also doesn't, if you look at it, it doesn't rise as much proportionally as some of the others. But there is something I was going to bring up in 2 graphs down the road that will clarify a little more of, you know, why it would never be a top winner. I mean, it could go down somewhat from here, but it's a fair point. Are there other questions or comments, observations? Okay. Sandy, was that fine, or did you?
All good. Yeah.
Okay.
Yeah.
All right.
Thanks.
So here's some graphs to kind of flesh this out in different ways. This is what you see on in silver color is the BERS portfolio current allocation. Here you have the common returns on the vertical axis, risk on the horizontal axis. What you see in red is what the proposed new weights would be in a basket clause, sort of if we were to utilize additional flexibility. In other words, go from a little less than 25% up to 31%, and based on what I mentioned, go up or down a little bit. And there's a couple things to mention on this chart. The first is that you notice that there's a large clustering of asset classes already around 7%, around medium, and the largest increases in the optimization model so far is in asset classes like infrastructure and real estate, which are, again, sort of in the middle of this market cloud. And there's not as much of a increase in private equity and emerging market equity, despite them being close to allocations where they would make a difference in adding to the basket clause, the definition of alternatives. Now, this whole chart is using the traditional assumptions that happened before, mostly before the bear market. But in any event, it's just the long-term return and volatility expectations. If we were to make a little more tactical modifications to those assumptions, this is partly what Sandy was referring to, you would see the same silver cloud hasn't been altered from the previous slide, but in blue, you would see the new weights for if you were to consider a slight modification of what those return and risk assumptions would be. And what's important to note here, there's a couple things. The first is that you can see why private credit and high yield didn't necessarily rise very high in the optimization model. It's just they're lower on a return basis than some of the other asset classes. They're low or not as high on a risk-adjusted basis necessarily. There's something else that's also worth noting, and again, this goes back to what Sandy's question, but when an optimization model solves for the risk for these investments, it's obviously going to look at these first order considerations that we're fairly familiar with, which is you want high return at the least amount of risk. But that risk means that your return for your portfolio is the average return of all the different asset classes you put in there. It's just the average. But the risk is not the average of all the different risks because you benefit from diversification to some degree. But what's less known, more higher order, is that there's in the optimization, it favors asset classes in the middle of the market distribution, market cloud, versus those at the further away, like the emerging market equity and private equity are further away. So in other words, another way of saying that is all things being equal, assuming no changes in the covariances, assuming that that's equal, an optimization model will prefer two different asset classes here in the middle than one or two different asset classes sort of on opposing sides that are symmetrical to it, even though they both would average to the same risk and return. The first scenario of having two in the middle just feeds through the optimization model and lets it rise in a way that makes maybe not as much intuitive sense, except when you consider the fact that it doesn't always prefer this convexity of things being so far from the center and what the error of measurement is on that. Now, there's this concept of an arc, a kink in the arc, where here we are right now, traditional assumptions, here we are with modified assumptions. I showed it both ways just to show that it doesn't matter if you change the assumptions or not, you get the same basic result, which is we have 24% of this subset of alternatives in the portfolio that's alternative. And as you, from our current state, raise the alternatives allocation weight, you initially benefit as you go from, say, 24% up to around 31%. You get a higher return, but of course you're optimizing on that, so you're getting higher return and you're getting some slight diversification benefit. That's all fine. But that doesn't go on forever. It does eventually break down where you've are no longer optimizing. You're no longer diversifying as much because the non-alternatives portion of the portfolio, the U.S. stocks, the core fixed income, they're playing a very key diversifying benefit that you're squeezing out by enlarging your alternatives. Again, you're going from 49% all the way up to 58%, even though it's showing a smaller value in the sort of basket clause definition, and so you're missing out on what are potentially some covariance benefits. Additionally, even though we're sort of around this range, it also suggests there could be some sensitivity, and I think it's just something to track along with anything else in future meetings and future risk work, is understanding as market conditions change, revisiting where we might want to be in an optimal overall asset allocation framework for different asset classes, including I think we're going to be well within the comfortable constraints of the basket clause limitations. So that's the presentation. There's plenty of time that I've built in for, if there's questions about this or the previous presentation on bear markets. So you can ask questions if you like.
2 questions, Salil.
Yes.
This analysis doesn't contemplate the leverage we have built in to the entire position, given the TDA fix, does it? I mean, that will have an impact on expected volatility and potentially the usage of the basket clause, I would expect.
It does not.
It does not. Oh, that's interesting.
Antonio, that's correct, right? I mean, this
Yeah.
is not.
Yeah, this does not have the currently, right? Like, I think I'd imagine that throws a huge, I mean, like, again, just in my presentation, it throws a huge wrench because even up or down, money's getting poured into that, like I can see a scenario where that's gonna be upwards of 30% of the assets next year. Like,
Well, that follows on. My next question is, the leverage will actually dramatically impact the cash flows in the system, along with the contributions from the city, which might bottom out to 0 in the next 6 to 8 years. So, I mean, this analysis will have to contemplate that also.
The asset allocation, when it's ultimately completed, in addition to having sort of like the enhanced risk modeling, things I mentioned in the previous presentation, is going to factor in the sort of nuances of what's happening with the BERS liabilities and on the composition of workforce, and also things about the practical considerations of pacing, this TDA, just a number of other considerations as well, to hopefully make it fairly real time and adaptable, so that you don't sort of have to wait maybe a year, year and a half a year, whatever, for like to kind of contemplate that it should happen a little more frequently than that, and you should have a sense of all things considered, all factors considered, what's the sort of best move, which deviates, like when I was doing asset allocation at HSBC, where you're just looking at for consumers and their retirement portfolios, you're just looking at mostly their assets, so you don't have to deal as much with differing liabilities. It's just the liability of one person. So hopefully that is a good step in the direction we hope to take.
Yeah, good start though. Thank you.
Yep. Other questions, concerns, comments? Oops. Yep.
Thank you, Salil, and to trustees and staff. Like this is a work in progress. I think Salil is going to be really like the work is going to be really insightful as we kind of build out what we believe would be a optimal asset allocation going forward, utilizing the basket room that we hope to get sometime before the end of the year. But we wanted to make sure, like, obviously this is a long and broad conversation with all of our partners, with all of your advisors, but we wanted to get started because we wanted to say, okay, in theory, what it looks like, because let's say if things come down to the wire as far as the legislation signed, at the very least, we want to at least have some way to put some of this in an annual plan that we show to you in the near future. So thank you, Salil, for the presentation.
Yep.
We'll have updates for the rest of the board as we move through this analysis. That is the last item for public session on the modified agenda. The next item for discussion is on a particular individual fund investment and thus belongs at executive session. Can I get a motion to enter executive session?
So moved, Tom Shepard.
Thank you, Tom. May I have a second?
Second, Nick.
Thank you, Nick. Any discussion? All those in favor, please say aye.
Aye, Tom.
Aye, Nick.
All right, any opposed? Any abstentions? All right. Motion carries. We are now in executive session. Karen, can you pause the recording?
Oh, okay, the recording has resumed. You may proceed.
Okay. Now, first report on executive session. In executive session, the executive committee discussed the authorization for the procurement of legal services for an individual investment fund. So the final item on today's agenda is the vote on the procurement of legal services. The recommendation is to authorize an agreement with Greenberg Traurig to provide investment legal services subject to the approval of the New York City Law Department for an amount not to exceed $25,000. May I have a motion to consider?
So moved.
Thank you. Tom, second. Donald? Oh, that's great. Thank you.
Yes.
So he said again, the recommendation is to authorize an agreement with Greenberg Traurig to provide investment legal services subject to the approval of the New York City Law Department for an amount not to exceed $25,000. Requested a roll call vote. Yeah, Donald, yes?
I would like to add a friendly amendment to
Yes.
that, just so everyone.
Can you speak up a little bit?
Should this be necessary? I think we should add that to the motion.
Absolutely. No, I think that's a great point. So, I think the best way to do that. So, regularly to authorize an agreement, provide investment legal service or not. So, how would that read? The recommendation to authorize an agreement with the Greenberg Traurig to provide investment legal services. Say should they be necessary, or trying to think about the wording for a particular resolution on this.
Yeah, Sharon is here. I think the legal language we can get from her.
I think only is subject to the approval of New York City. It maybe come after this modification after subject to the approval of the New York City Law Department. And
Don, you want this contingent on, when you say should it be necessary, what exactly are you referring to?
Yes. So I think that's better language. Yes, contingent upon I guess BAM and BERS moving forward. Or should both sides not agree, we at least have this authorization to do so.
Something like in the event the Bureau of Asset Management is unable to provide legal services. Something like
Yes,
that.
I think that works. Much better than my language. Thank you, Sharon.
Okay, let me see.
I just think that would be fair to add that based upon a conversation that we've had.
I think that's right, Donald.
Okay. Yeah.
So how does it read now, Sharon?
Resolve, the second to last resolved would be in the event that the Bureau of Asset Management is unable to serve as investment counsel and subject to the approval of the New York City Law Department, the Executive Committee authorizes the Executive Director to enter into an agreement with Greenberg Traurig. Let me see if I can just share my screen. Can you guys see that? Can you see
Yeah, I
my
can see
screen?
it.
I can see it.
Okay.
Yeah.
Is that fine?
Yeah, looks good. How do folks feel on that?
I'm fine with that.
Then let me ask this then. Given that change in the addendum that Donald added, would a roll call vote still be necessary from the board, or would any board member still request a roll call vote?
I think we should still move forward to do that, Antonio.
Okay, absolutely. So do a
Yes.
roll call vote there. Absolutely. All right. So Sharon, should I go through the whole resolution again, or can I simply go to the vote?
If everyone is okay, I think we
Yeah.
can go to the vote.
Absolutely. All right. So we will start for the vote. So Benjamin, start with Ben. So Benjamin Schonbeck.
Aye.
Thank you. Gregory Faulkner.
Yes.
Donald Nesbitt. Nicholas Studo.
Aye.
Right. The motion carries. That is the final item for the July 2022 executive.
Antonio?
Yes. Oh, sorry, I
Didn't I-
missed you, Tom. Thank you. Tom Shepard.
Aye.
Thank you. Sorry, I went back up to my list from the beginning of the meeting instead of the second one. Thank you. Apologies for that, Tom. So the motion
No
carries.
worries.
So that's the final item for the July 2022 Executive Committee meeting. The next meeting for the Board of the Executive Committee is scheduled for Thursday, August 18th at 1 o'clock. We'll see if we actually have that. I'm not sure if we'll have any investment items there, but it's scheduled for Thursday, August 18th. Is there any other matters that folks want to bring to the board before we adjourn? All right. Then I need a motion. I have a motion to adjourn the meeting.
So moved.
Thank you, Tom. Say a second.
Nick.
Seconded.
Thank you, Nick. Any final discussion? All those in favor of adjournment, please say aye.
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 All right. And no, I don't think anybody opposed. Everybody say aye. Thank you, and we'll be adjourned.
Take care, everyone.
All right.
Bye-bye.
Have a good day, everyone.
Thanks.
You
Bye.
too.
Bye-bye, everyone.